Silver just crossed $100. But here's what no one's telling you about this number. It's not arbitrary. It's not psychological. At exactly $100 per ounce, the mathematics of the global silver market transform in ways that make a massive price explosion virtually inevitable. Think of the silver market like a massive lever. For years, that lever has been balanced on a fulcrum of complex derivatives, paper contracts, and margin requirements. But at $100, the fulcrum shifts. And when a lever that big shifts, the consequences are explosive. Let's start with what happens at COMEX, the primary futures exchange for silver. Right now, to control one standard silver contract representing 5,000 ounces, traders post initial margin of about $12,000. That's reasonable when silver trades at $30 or $40. But COMEX margin requirements aren't static. They're calculated based on price volatility and absolute price levels. Here's where the mathematics get dangerous. When silver crosses $100, COMEX margin requirements don't just increase. They triple. Suddenly, that $12,000 deposit becomes $36,000 for every single contract. Now multiply that across the entire COMEX complex. Open interest currently sits at about 150,000 contracts. Do the math. That's $50 billion in additional collateral that must be posted within days. Where does $50 billion in emergency collateral come from? It doesn't, which means positions must be liquidated en masse. But the margin spiral is just the beginning. The real breaking point involves leverage ratios that would make even cryptocurrency traders nervous. According to silver market analysts tracking COMEX data, the current ratio of paper silver to actual deliverable physical silver stands at 500 to 1. 500 paper ounces for every real ounce sitting in a vault. This works fine when silver trades at $30. Paper traders can roll contracts forward indefinitely. Physical delivery remains a tiny fraction of trading volume. The game continues. But as Ted Butler and other silver analysts have documented for decades, this leverage ratio becomes mathematically unsustainable above $95. At 100, it breaks entirely. Think about what 500 to 1 leverage really means. It's like 500 people each holding a ticket to the same concert seat. As long as only one person shows up, no problem. But when silver hits triple digits, industrial users can't afford to play paper games anymore. They need real metal. And suddenly, all 500 ticket holders want their seat. The options market adds another layer of explosive dynamics. Traders call it gamma squeeze when option hedging creates a feedback loop that accelerates price moves. The concentration of call options at the $100 strike price is unlike anything in silver market history. When those options go in the money, dealers must buy physical silver or futures to hedge. That buying pushes prices higher, putting more options in the money, forcing more hedging. It's a spiral that feeds on itself. We've seen this movie before, just in different markets. In March 2022, nickel prices on the London Metal Exchange went from $20,000 to over $100,000 per ton in under 48 hours. The exchange literally had to halt trading and cancel billions in transactions. In 2021, palladium spiked to nearly $3,000 per ounce when industrial users panicked about Russian supply. But silver's setup is far more extreme. Nickel and palladium are niche industrial metals. Silver is monetary metal with 4,000 years of history, industrial metal critical to green energy and electronics, and the most shorted commodity on Earth. When its market structure breaks at $100, we're not talking about a specialized exchange halting for a few days. We're talking about a global repricing that cascades through every electronic device, every solar panel, every monetary system still holding physical reserves. The mathematics say it starts at exactly $100. And according to Shanghai Vault data showing critical shortages, we may not have to wait long to see these calculations tested in real time. The paper promises are about to meet physical reality. And at triple-digit silver prices, reality wins. Every time. The paper promises are breaking. Right now. At COMEX warehouses in New York, Chicago, and Delaware, vault managers are staring at a number that should terrify anyone holding paper silver contracts. Registered inventory, that's the actual physical silver available for immediate delivery, can cover just 2% of outstanding contracts. 2%. Let that sink in. If you're one of 100 contract holders and you all decide you want your physical silver, only 2 of you are getting metal. The other 98? They're about to discover what happens when paper promises hit the wall of physical reality. This isn't theoretical. The COMEX warehouse system divides silver into 2 categories. Eligible silver sits in approved vaults but isn't available for delivery. Registered silver is what actually backs the paper contracts. As of today, registered inventory stands at about 30 million ounces. Sounds like a lot? Not when open interest represents 1.5 billion ounces of paper claims. When silver crosses $100, industrial users can't play the paper game anymore. They need physical metal for manufacturing. Solar panel producers, electronics manufacturers, medical device companies, they all hit the delivery button simultaneously. Within hours, those 30 million registered ounces evaporate. Then what? Enter the force majeure clause. It's buried in the fine print of every futures contract, but most traders never read it. Force majeure allows exchanges to suspend physical delivery when circumstances beyond reasonable control make delivery impossible. Running out of silver at triple-digit prices? That qualifies. We saw this playbook in March 2020 when gold refineries shut down. COMEX invoked force majeure-like conditions and allowed delivery of non-standard bars. But that was a temporary logistics problem. When silver vaults empty at $100 an ounce, it's not logistics. It's depletion. The London over-the-counter market makes COMEX look conservative. While COMEX at least publishes warehouse data, London's OTC silver market operates in shadows. Industry estimates suggest leverage ratios approaching 1,000 to 1,000 paper ounces for every physical ounce. It's a derivative hall of mirrors where nobody knows who owns what until everyone demands delivery at once. Here's where it gets truly dangerous. When physical delivery becomes impossible, exchanges shift to cash settlement. Sounds reasonable? It's not. Cash settlement means the exchange picks a price, any price, and forces contract holders to accept currency instead of metal. But what price do you use when the physical market has disconnected from paper? During the nickel crisis, the London Metal Exchange retroactively cancelled $12 billion in trades and set an artificial settlement price. Market participants sued. They're still in court. But imagine this happening in silver, a market 20 times larger with monetary implications nickel never had. The mechanism works like this. COMEX declares force majeure. London follows within hours. Contracts that promised physical silver at $100 cash settle at whatever price the exchanges decree. Maybe 120, maybe 80. The number becomes meaningless because price discovery, the fundamental function of these markets, ceases to exist. Physical silver starts trading on black markets, peer-to-peer networks, local coin shops at prices double or triple the official settlements. The Shanghai Gold Exchange, which requires physical backing for every contract, becomes the only real price signal left. And according to recent reports of vault depletion there, even Shanghai is running on fumes. This is what market structure failure looks like. Not a crash, not a spike, but a complete disconnect between paper prices and physical reality. The infrastructure designed to price silver for the world suddenly can't deliver any actual silver. Traders holding paper contracts get settled in rapidly depreciating currency while physical holders name their price. Industrial users watching this unfold face an existential choice. Accept that silver might become unavailable at any price, or start hoarding immediately. For companies whose entire production lines depend on steady silver supply, it's not really a choice at all. The paper market is already dead at $100. It just doesn't know it yet. The boardrooms of the world's largest industrial companies are in crisis mode. They've just watched paper-silver markets detach from physical reality at $100 an ounce. Force majeure declarations, delivery failures, cash settlements at artificial prices. Now these CEOs face a decision that will determine if their companies survive the next 12 months. Here's what they know. 70% of global silver mine production flows directly into industrial applications: solar panels, electronics, medical devices. The backbone of modern technology runs on silver. And there's no viable substitute. For decades, these companies operated on just-in-time inventory models. Why stockpile expensive metal when you can order exactly what you need, exactly when you need it? The system worked until silver hit triple digits and the assumption of constant availability shattered. Chinese industrial users began stockpiling at $80, forcing competitors to follow or risk shutdown. The mathematics are staggering. Annual mine production is 800 million ounces. Industrial users consume 7/10, 560 million. If they collectively seek just 6 months of forward inventory, that's an additional 230 million ounces demanded overnight. But global above-ground available inventory totals less than 200 million ounces. 6 months of industrial forward buying would consume 3 years' worth of mine production. It's physically impossible, which means whoever moves first gets silver. Everyone else gets shut out. This triggers a panic spiral. Company A doubles inventory. Supply tightens. Company B triples. Company C tries to buy a full year forward. Within weeks, industrial users are locked in a frenzied bidding war for rapidly vanishing supply. The solar industry sits at the epicenter. China leads global production, and they're hoarding first. Electronics manufacturers face identical pressure. Your smartphone, laptop, car electronics all require silver's unmatched conductivity. Indian and European firms now report silver paste shortages and delivery delays. The cascade has begun. At $100, hoarding shifts from prudent to panicked. Every procurement officer knows the stakes. Hoard immediately. Hoard aggressively. Because in weeks, there won't be any silver left to buy at any price. The spiral feeds itself until available silver simply disappears. It's not a rally anymore. It's a detonation. The last registered ounce of silver left the COMEX vault on January 28, 2 days after the price crossed $100. What followed wasn't volatility. It was physics. Because once the physical supply vanishes, truly vanishes, the feedback loop doesn't just engage. It compounds. Every $10 move above $100 doubles the margin requirement for every open contract. This isn't linear escalation. It's exponential collapse where each price tick forces more liquidations, which drain remaining liquidity, which forces more price spikes, which trigger more margin calls. Industrial users aren't waiting. They're accelerating. European electronics firms are now placing orders for 12 months of silver paste, not 6. Indian medical device makers are bypassing exchanges entirely, sourcing directly from refiners in Mexico and Peru. Why? Because the window to secure metal is shrinking not in months, but in days. Panic isn't emotional here, it's arithmetic. That's when monetary demand arrives not as speculation, but as survival. As silver's paper markets fracture, and cash settlements decouple from reality, central banks and sovereign wealth funds stop treating silver as a commodity. They treat it as settlement infrastructure. When the dollar's credibility cracks amid paper market failure and geopolitical stress, institutions reach for the metal that's already moving, already scarce, already weaponized by its own supply failure. The historical precedent isn't a suggestion. It's a blueprint. In 1979, silver surged 700% in 12 months from $6 to $50. Today's conditions are tighter, faster, more interconnected. 500 to 1 leverage, depleted inventories, and strategic industrial dependency. If that velocity repeats and the math says it must, then $180 isn't optimistic. It's the floor, and it arrives within 90 days of that $100 break. This isn't about silver hitting $150. It's about what $150 means when a single semiconductor fab orders 6 months of silver in 1 day and finds only 3 weeks available. At $100, something broke. At $150, the infrastructure fails completely.